Greetings, Dr. Jeffrey Scott, and this is my part two of my weekend market update. I started doing this last week where I did my market analysis early after the close on Friday, and I've had a chance to look at stocks throughout the weekend. We'll come back for a short review of what I thought the market was going to do, and then maybe identify a couple of stocks. So I think maybe is the key word considering the futures right now. Again, the title is Market Set to Open Lower on Tariff Tantrums. My name is Jeffrey Scott. My email address is marketmripro@gmail.com, and my Google group is called Top Down Trader. As always, these videos and all my teaching is for educational purposes only. Anything I talk about should be taken in the spirit of education and not investment advice. The intent of the video is to demonstrate the tools of top-down analysis and how I apply them. Trading involves risk, and you alone are solely responsible for any investment decisions that you make. I may own or intend to buy any stock we talk about. Trading stocks and options should be considered risky, and you should always consult with your financial advisor before making trades. And I have tools for multiple platforms, but I am an independent trader. My Google group is called Top Down Trader. You just stick Google Groups in your URL. You go there, you log in with your Google ID, look for all groups, search for Top Down Trader. You let me know how you want to be contacted, and then you'll be hooked up in the group. It's not for solicitation or anything like that. I push information out there. I push discounts on my tools, and we do a lot of educational programs where, for example, what I did this week, I only post there because I go a little bit beyond what I feel comfortable putting out in YouTube land. Busy week. And I did this on the Friday night, so I'm not going to spend much time on it, but you've got everything you could possibly want. You got CPI, you got PPI, you got jobless claims and import prices. You've got Fed governors and presidents all over the place speaking, and you got housing starts, building permits, and consumer confidence. This is like the July 4th of news. I mean, this week. It's going to be fireworks city, plus you're going to have whatever came out of Friday night, Saturday, and Sunday, Trump's comments about Mexico and EU and 35% tariffs, balanced by the EU coming back and saying, well, that they're going to delay any of their retaliatory type of tariffs until August 1st, so at least a hope that there could be some conversation. And if that's not enough fireworks for you, you got a lot of earnings this week. The big banks, the little banks, some pharma, and oh yeah, this little 4-ticker stock called Netflix. So it should be a heck of a week. It is a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. Thanks to those that joined my video seminar on Saturday morning. The only place that video and those slides are posted are in the Top Down Trader group. You just have to go through and look at the emails from Saturday afternoon if you wanted access to those. Not only did I go through deep dive into my program called Market MRI Pro, I also showed my performance and how I doubled my account. Again, the backup for that, the proof of that, you have to go to Top Down Trader and look at the presentation. But how I've been able to double my account in a relatively 6-month period of time in a market that's relatively flat, although flat is like calling fireworks lighting a match because it's been up and down. It just is relatively flat year to date, but boy, there have been a lot of moves between here and then. I do discount the product. There is a sale that is basically over. I'll extend it because I'm doing this video today until Wednesday. If you ask for a trial, you'll get extended to Saturday. And there is a 1-week trial that we offer on the product. So again, we had a great session. Just join Top Down Traders. You have all the emails from me and go to the one that's basically recaps the meeting. It has a PowerPoint and it has a video if you're interested. If you're a current customer, you have any issues, Market MRI Pro, call coding at marketmripro.com. If you um, want more information, just reach out to me at marketmripro@gmail.com, and my Top Down Trader Google group is where to go. I also announced that my good friend and kind of neighbor, since we both live in Florida in the same area, John Person, is holding a seminar October 24th and 25th. I will back to back and start mine on do one 26th and 27th in the West Palm Beach area. Reach out to me if you have any questions. I got to get at least 10 people in the room before I'll open it up to streaming, or 10 paid people, and then I'll open it up to streaming. I know some people pay even though they know that they're not going to be there live, so they get the videos and access to the streaming. Again, marketmripro@gmail.com. So when we looked at the markets, I talked about how my timing model is still long on the weekly, the daily, and the monthly, but I'm seeing concerns. And some of the concerns that I saw were, if I went back here into the market breadth, new high, new low, and it's going to open up a number of the major indices. Usually I load it first, but I wasn't thinking. We have the spiders, the NASDAQ, we have the S&P 1500, and we have the Russell. I would say worst case scenario, these have been flat over the last several days. Over a longer period of time, they are all been up. And when you look down here at the RSIs, you got lower highs. You've got RSI divergence on each of these broad indexes. That to me is part of the concern. When I run my program that looks at MACD divergences, they're all over the place in the S&P 1500, probably about 100 of them. So when I see these types of patterns, I start to think that the market's getting tired. We looked at the indexes, and again, for more in-depth, I refer you to Friday the 11th email. But when we looked at the indexes, talked about how it was a negative week, the worst being the diamonds, the spiders, the NASDAQ, and the Qs did better than the Dow and the Russell. But you can see we've sort of flattened up here. Seasonality is okay for a while, but as we get into deeper parts of September, we start to get worse seasonality. Just look at this real quick because something didn't look right. Yeah, that date's not changing, but as we get out here, which is September, this is daily. I'm sorry, that's why I was thrown for a loop. But as we get further out and we get into August and September, we get a pullback into, typically we turn around in October. So we have had a great move off the bottom, a true V bottom. We're sideways. Could see a little bit more strength to the upside. But with all this news hitting this week and the tariff tantrums, I think it might not be wrong to think that maybe we've put in a short-term top. So I'm a little cautious here, but with all my signals still saying be long, I'm not going short as much as raising cash. Again, the Qs sideways move up here at just off all-time highs. The diamonds did not hit all-time highs, but they're two going sideways. Maybe they're flagging here to go higher. Again, similar pattern off the bottom and decent seasonality for a little bit longer. If we look at the Russell, the big deal on the Russell to me was when it took out its 200 after previously failing. And you can see it does have good seasonality, although it had a challenging week this past week. All of these have 200s with the 17 and the 50 below them. They all have some element of support. If we do get a pullback, I don't expect it to be a massive pullback like we saw in here. But 8-10% correction and then go on and end the year at higher highs makes sense to me. I look here at the VIX futures, and here it's probably showing me, let's see, is that the week of the 10th? Okay, that's the right week. We could see on the futures The VIX futures were up about 4% on the week. And one thing I've been watching is the dollar, and it's kind of at a point now where it looks like it's ready to break through this trend line, which has been resistance. And if we see dollar strength, that's probably not something that's going to be awesome for the U.S. markets. On the commodity side, gold up a little bit, but silver up to multi-year highs. Now, it'd be interesting to think that silver is at all-time highs, but it's not. But you have to go all the way back to the 2011 area. Let's make that big. There we go. Let's make it monthly. And let's give us some more. And more. There you go. This is when the Hunt brothers were famous with what they were doing with the silver markets. But you can see we've had a massive run off of a bottom. And to me, silver looks more attractive to be long than gold. But both have been doing well. Oil on the daily charts had a little bit of a bounce on Friday. A lot of conflicting stories there, more production. Then you have to look at what utilization is going to be, and is utilization going to be stronger than expected? Natural gas, I'm not even paying attention to, and both the 10-year and the 30-year were up. So I put it all together. I think the market's got a little bit of pressure. I wasn't surprised that the futures opened lower, especially considering the comments of the weekend. But I'm going to take a quick look at them. They've actually come off their lows. So even though they dropped at the open, they're not massively dropping thereafter. So maybe we'll see them revert back to where we closed on Friday. So when I looked at stocks this weekend, the first thing that I want to point out is that when you look at stocks from a top-down perspective, and I got to take off my filters. Let me do that real quick. But when you look at stocks from a top-down perspective, we're seeing rotation. And when you see rotation, like the rotation that we're seeing, is you're seeing the previous leaders are coming back, and some of the things that have been, 3,600 stocks, that have been lagging are going to show up. So if we were to look at, and these are 3,600 stocks and sectors and industry groups, much broader than the S&P, so they're going to look different. But if we ranked them by what was doing well, and we just took the top three, energy, utilities, and real estate, and then we came over here and we ranked them by what was doing well, and let's take the top 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. And first let's look at maybe making this list, which is 183 smaller, by putting on a filter for $5 and a filter for $500 and hitting OK. And now, how do we want to rank them? We can look at them by percent change. Sometimes that brings up some wild things, like this one actually is interesting. This is an LNG company. Now, when I see a move like that, I can flip here and say earnings are not to August 13th. Their earnings are all over the place. That's not why it moved. Is there any news? Now, that's an interesting story. Reliable LNG. So two very positive stories. You can click on the link and you can get the report, and if you want to read it. So the concern here is this thing's kind of extended. It's at 100%. Odds are the stock whittles down a little bit before it goes higher, but we'll watch and see. Now it has my two momentum signals in a row, which has been a strong indicator of doing well. But look what happened here. It had two indicators in a row, and then a couple of doji days, a head fake down, and then boom. So my guess is it will go higher, but the question is, will it pull back first? Ramaco Resources. Now, the interesting thing here, that's a beautiful breakout. It too is getting a little bit extended, but since everything was sort of flat for such a long time, and these moving averages are so close together, I might not be afraid of looking at this. This is a coal stock. Now, who wants to buy coal? Not anybody I know. I don't got any fundamentals on it. All right. Ramaco Resources. VG, which used to be Vonage, is now Venture Global, an energy stock. Um, Taking out this, I got to tell you about the yellow line, don't I? Let me kill that for now because I don't want to talk about it yet. But that is a chandelier stop that I added to the chart. All right, so I'm breaking out above the 17, not a lot of dots here. I'm going to pass. UEC, uranium is hot. That's probably a laggard. LEU is probably a really good looking uranium chart. Centrus Energy Corp. You can look at it here. I'm pretty sure they'll do something with uranium. There it is. Uranium, uranium, uranium. Uranium is hot. I think they're in the services side. So maybe we just found the stock that we want to go look at. And if you think about it, the market bottomed in April. These things have been a rocket. And they fell with the market to some extent. But boy, and the difference here is the high jump is 38. Excuse me, I should put my glasses on. 88, so it's not above 95. So it's still something I could buy. So we'll think about looking at LEU. CNR, another stock with two dots. Did LEU have the two dots? Nope. And that means two major momentum days in a row coming out of a squeeze. CNR, which I sort of ignored when I looked at it on Friday. Uh, this is a 3.6 billion market cap coal company. LPG, Dorian LPG, a nice little breakout here, getting extended. SMR, nuclear power utility, nice little pullback. I need a little bit more to show me, maybe some green dots, some volume, breakout momentum. And relative strength and OBV both look like they're getting ready to cross over, which I'd like to see that as well. Venom is an exploration and production that's pretty low. BP has been a laggard in the integrated utilities forever because they divested some of their oil, as I understand it, and invested in alternatives. They had a press release, not a press, they had a analyst meeting last week, I think on Thursday, and they weren't as bad as people thought they would be, and you could see they jumped. That might be interesting. I actually took a long position there, but it's a short-term position just to see if they get any more play. Looking at this list, I see more coal. BTU, too low in its pattern. CCJ, uranium, probably the best of the uranium plays. And pulling back here, had a positive day on Friday with a CPR signal. That one doesn't look too bad either. So heavy concentration of coal and energy up at the top of the leader stocks. No surprise, it was the one group here with the large database that was positive. All right, another thing I could do is rank and look at the best industries. I skip the black one, those are usually IPOs. And just see if anything else comes up to the top that we weren't looking at. Percent change from the. This is I believe, a company in the drone side. This is one that's on my watch list. It's got those two blue dots at the bottom there in a row, which is a big momentum signal. I like that one. There's a lot here that I like on this list. More of the coal stocks are back here, no surprise. On the silver front, PAAS is one that looked good. It's in an uptrend, pulled back, and it broke out. As I said, silver is leading right now. And the other things that are starting to move are some of the shippers. Here's Star Bulk carriers. These things have been out of favor for a while, but are they getting ready to run? Don't know. So that's all from a top-down perspective, some of the things that I thought were interesting. Now, if I go from a bottoms up, I just have a couple things I like to do. Back to let's turn off the filters. Back to my 3,600 stocks, and what I'll do is I'm going to look for pullbacks and uptrend, $505, hit OK, got 315 stocks, and RCAT nice breakout here. Now, the challenge with RCAT is that it has fleas. By fleas, I mean is I don't know enough to say if it's safe or not, but there's a bunch of lawsuits that were filed, and I'm sure it's related to the losses and concerns. But you see this all the time, and just because a lawyer is asking for damages or to discovery does not mean the company did anything wrong. Massive volume, CPR, gap, volume, breakup, momentum, relative strength, and OBV broke out. I think RCAT looks really interesting here, and it's a stock that's at $8.57. Another one that looked really good is Astronics, and they are in the defense industry. And I know this is probably what Quilamaji would have referred to as an episodic pivot. A stock that was pulling back or basing, had a massive volume, a big gap, volume, breakout, momentum coming out of a squeeze, good relative strength OBV, not extended. I like this one a lot. So ATRO and LEU are probably my favorites. I wonder if either of them have enough option volume to even look at it. So I'm just writing those two down. ATRO, LEU. I guess if they're not, there's always CCJ. What else do I like here? MAG is another silver stock. It looks like it's getting ready to run. It also had the two dots. I can look at, let me kill my filters. I have a list of FANG Plus. Just look at them real quickly. Again, it all depends upon the markets tomorrow. If the markets open down big because of the temper tantrums, I'm not sure I'm going to be going long at all. But until it reverses. Amazon is off the bottom. Nice little uptrend. Had a little bit of a pivot back here. I think if the market opened flat, Amazon would be something I would look at. APP has been very volatile as it's come off of its high here. It's below the 50. I'd be watching. Google is setting up nicely. A break above this line here. What's interesting, this is where they failed. Broke above it. Failed at it several times. But if we break out above here, I think Google looks interesting. Meta had been a big leader, and you can see Meta has pulled back a little bit. But boy, still a leader. Microsoft on fire. Netflix pulling back to the 50. Now Netflix has earnings this week, and it looks like it has a little pop to the upside on earnings historically, but we're in a season, kind of a flat seasonality. Nvidia all-time highs, broke the $4 trillion market cap. I don't know if I should be worried about this topping tail. I might be concerned when I look at this, and what's a high jump? It's like 87, 89. So it's getting extended, but it's not the max extended. But that kind of looks like it's ready to take a pause type of a candle. And then Tesla still has to deal with the Trump versus Musk. So I'd pass on that. So Amazon and Google both look great. Meta and Microsoft are doing fine. Netflix is pulling back to a perfect buy opportunity. And Nvidia, it's to the moon and back. Well, hopefully not back because it's my biggest position. So let's look at potential trades on ATRO and LEU. So I'm going to pull up my favorite way to analyze options. And did I not? Here it is. The program is called Options Pro. This is a version that I get with VectorVest, which I think I only still subscribe to it because I never cancel anything. And I've been subscribing since the DOS days. But I really like the options platform, although I could get it freestanding. So we're going to look here again at ATRO, flag and a breakout, and LEU. Challenging highs. All right. So the question is, will either of them have enough volume? ATRO. 28. Yeah, they got very little open interest. The problem if you don't have much open interest is your spreads are too big. So that doesn't look good. How about LEU? All right, we've got a little bit more volume. Still pretty wide spreads. I don't know. Not a lot of options interest. Well, let's just look at this from an options perspective. Stock was in an uptrend. Remember, it pulled back, and it looks like it's going to run again. It's sitting at $206, and I want to be long. So typically, I list here some of the trades that I could take as being long, and I start to investigate which one would make the most sense. So if I bought the stock, and this is the baseline, and it's a very important graph. If I bought 100 shares at $206.40, and that was the last price, but it's somewhere in between, I would have to spend $20,640 thereabouts to control 100 shares. That dash is where I bought it. As it moves to the right, I make profit. As it moves to the left, I have a loss. So the benefit of buying the stock is I don't have to move to break profitable. I don't have to cover the cost of a premium. So I think that buying the stock is fine, but most of us, even with a big account, there's only so many shares you can buy of a $206 stock. So one thing that people might think is, well, I'm going to buy a call because a call, 10 calls will control 100 shares. So let's look at one call rather will control 100 shares. 10 will be 1,000. So I don't know why it's doing it that. So here, oh, it doesn't like me. So let me get this. It happened to me before. Let me see what I did here. I bet I have to do this. There we go. So remember the stock. If I bought the stock, it didn't have to move at all. But I had to spend 20,000 to control 100 shares. Here, I could buy an in-the-money call for 26 bucks. So that $26 will control 100 shares. The most I could lose is the value of my call. So the most I could lose on 100 shares is 26.40. I have an infinite opportunity. Now the problem is it's going to have to go up from 206 to 226.40 for me to break even. So the only downside about this trade, except besides it's a lot of money in premium, is it's got to move a lot to be profitable. So maybe not my favorite trade. But can I get something that looks like this pattern, which is infinite upside, limited downside, but I don't want to spend $26 to control 100 shares. All right, what else could I do? How about a married put? And I don't know why that's doing it to me, but we know how to fix it. Okay, so the married put looks just like that, doesn't it? Interestingly, buying a call looks similar to a married put. Now let's do the math. I have to spend, for that put, I'm paying 20 bucks. All right, somewhere between 1850 and 1960. So they said 1905. So the most that I could lose here is $19.05. No, that's not the most I could lose. The most I could lose is the delta between the strike price and the call and the list price of that call and the strike price of that call. So that's $6.40 plus 1905. So in the call I could lose $26. Here I can lose $25.45. I have a little bit less space that I have to move to be possible. But isn't it interesting that buying a call or buying the stock in a put at the similar strike price gives you the exact same curve? Um, Now, the beauty of this trade is it doesn't matter what the stock price does. The most I can lose is the cost of the put and the room to the strike price. The bad news is it's still expensive to get in. So I don't have a problem with this trade, and I'm getting more interested in married puts of late, especially as we're topping in this market. How about a call spread? So remember, I wanted unlimited gain and to limit my downside. So what does a call spread look like? Let's look at a bull call spread. $10 apart. Okay, that's fine. Now, looks a little different, doesn't it? I've got the same thing on the bottom that's capped, but my top is also capped, and the trade is I'm buying a 200 and selling a 210, so the most I can get from that is $10. I'm paying $4.30, so this is only $5.70 or $570 is the max I can make. But now the most I can lose is $430 or $4.30 a contract. So if I didn't want to spend $25 or $26 to control with an infinite upside, I could look at something like this, but it's sort of a taking your sister to the prom trade. You're still going, you're still going to have a good time, just don't kiss her goodnight. Um, but it's not a winning trade. I mean, yes, you can win. You can make back $5.70 on your $4.30 investment. Not my favorite trade, but we'll keep it in mind as we look at other options. Again, I want cheap, controlled risk, but I want as much gain as I can get. All right, what about selling a put? All right, now selling a put's another common trade, and even though I don't love this trade, it's a trade that most of the really wealthy people do. And I don't know where wealthy people start because I could afford to do it, but I don't like the trade. And when you're selling a put, is you're capturing here. If you sell a $200 put, you are going to have the obligation to buy the stock back at whatever price it is at the expiration date. You don't have to wait to expiration date. You could get out of it right away, which is what this dashed line is. As the price goes down, your loss goes up. The problem with this trade is you've capped your gain. But remember I said you had to move in the direction of the you had to go up to cover the cost of the option. Well, here you're collecting $19. So and you're collecting $19 off of a 200 put, as long as it stays above $181, you make money. So this is actually a great trade. Again, you have capped your gain at what you're collecting, which is $1,905. You're risking the whole enchilada, but no one says you have to hold it to expiration. And the stock can move up to 10% against you. Now, why do the richest people in the world like these trades? Because they have so much money that they're willing to risk that 1, 5, 10% of the time that the stock drops that much, and they're just collecting a huge premium on their money. And if they ended up having to buy LEU for $20 less than it is today, they're happy. Again, not unlimited upside, and it's not why I don't love it. Bull put spread, I don't even like this one at all. All the bull put spread is doing is it's capping your up and your down. But unlike a call spread, you're collecting $4.40 per share on 100 shares, and you're risking $5.60. Now, again, similar story to what we talked about before. This thing could drop up to $4.40 before you're paying anything back. And that's one of the beauties of these put spreads is you're putting premium in your pocket, but you don't have the unlimited upside. I'm buying this because I think it's going higher. So let's talk about a couple of my favorite trades. How about doing a butterfly? Man, this is like parachuting from 30,000 feet onto a landing area the size of a quarter and sticking it. To maximize your win on a butterfly, you have to be perfect. Just ask my mother, my wife, my daughter. I'm not perfect. Now, my granddaughter, she might say I'm perfect. Maybe, if I took her shopping. But this is how you construct a butterfly. And in this case, we bought one call at $190. So 100 shares. We're bought at a strike price of $190 and we're paying $31.80. We are selling two calls at $200 at $26.40 each. And then we're buying another call with a 210 strike for $22.10. So here I can control 100 shares for $110. Or, yeah, 100 shares for $110. So this is like going to Vegas and playing something where the odds of you winning the max might be 30 to 1, but you're going to keep doing it because it only costs you $1. I don't like those odds. Do I have unlimited gain here? No. I'm right on the stock. LEU goes to 300. How much did I make? Oh, I lost because once it got above 209, I was negative. So let me show you how I could change this butterfly to where it becomes one of my favorite trades. It might be how I take this trade. Let's edit the spread. Let's take this to 210. Let's take this to 220. This is how I like to skydive, where I have a really wide area that I still make money in. So here, the downside is I have to pay $5.65 per contract, but the upside is the stock has to go down in value for me, and quite a bit for me to lose money. Okay, it's got to go down in value. I lose a little bit when it drops. Well, it's got to go to 206, so the 210 is the short calls. If it drops below 195, I have the maximum loss I can get pretty quickly. But if it goes up, and I'm buying it because it goes up, even if it goes through the upper call, I still make money. This is called a broken wing butterfly. It's how I enter many of my trades on expensive stocks. Why? Because for $5.66, I can control a share of a $206 stock, and if the stock goes up, I make money. The maximum I make is up here is $1,435, but if it blows right through my stop, I'm going to make 20 minus 10, which should be about $10. So if I get paid 10 and I cost me $5.65, then I'm making $4.35 on that trade, which is about 80% return. I can keep making it no matter how high it goes. If it moves less than this amount, I'll make more money on the trade. And I like this because I can enter. Now, I might look at this and say, these are still big dollars. What if I make it even better for me? What if I change that to 220 and make this one 230? Now I've got 30 on the long spread and 10 against me. Now it's going to get more expensive. I bet it gets closer to 10 bucks. Let's see what it cost. $10.50. So now I got to decide. Would I rather spend $5 and make 10 minus the 5 for 5, or would I rather spend $10 and make 30 minus 10, $20? I mean, you have to decide. Here it's going to cost me $10 to get in, but my profits are double if I'm right in direction. If I'm wrong in direction, at 10.50 for 100 shares, it's still a lot less money than buying a call or a married put. But on both of those, I have unlimited gains. This to me is a safe trade because I've controlled my downside. I've taken the standard butterfly and gave me a much bigger landing area. It's less expensive than a call. Remember that call was like $26? That married put was like $25. I'm getting in for $10, and I let the worst case scenario, if it goes up, is I have a $20 difference here. Excuse me, minus 10, or a profit of 19.50 is the max up here, but it's going to be about $10 or 9.50 when you get down here. And if I'm wrong, I've sacrificed my 10.50 $1,050 for the trade. The broken wing butterfly, you can change the strikes, you could change the targets. Let's change the strikes a little bit. And let's change this one to 200. Leave. All right, so now I'm closer to the money, still about the same $5. So I kind of liked how they constructed it, where I was already deep in the money on the short call. All right, that's not a bad trade as far as I'm concerned. The other one I wanted to talk about tonight, well, there's a couple. A call ratio back spread. All right, don't pay attention yet. There you go. Gives me some of what I liked about buying a call or the married put. It gave me that unlimited upside line, okay? It gave me the fixed downside. Now, this is an interesting trade. I'm going long a $200 call. Excuse me, I'm going short a $200 call, and I'm getting paid 26 bucks. I'm going to take the that proceeds, and I'm going to buy two 210 calls for 44 bucks, and among friends it's going to be about $18. So here I can control 100 shares for $1,800 or $1,780. But it's a weird trade construction-wise. What happens before I get to the $210? All right, remember I'm already at $206.40. Between now and getting to the $210, the value of this call is going to max at $10. The value of these 210 calls is going to continue to fall if it doesn't get above 210. So if I finish between 200 and 210, not only do I have to pay a debit of $1,780 to get into the trade, I'm going to have to pay whatever that call is worth. If it's $209.95, that's a $9.95 per share, or $995. So that risk in this trade, $1,780 plus $990 gets you to $2,780. The call risk was about $2,600. Why would I take this call instead of take this trade instead of the call? Well, the first thing is I'm paying only $1,780, and I have less of a move from where I'm at till I get profitable. But the real reason is if I totally screw the pooch And you think about markets go up, they go down, they stay the same. If the market drops, I don't lose any more than the 1780. So I'm basically getting a lot of what I liked about the call at a lower price. And the risk I'm taking is this area here, where my risk increases as we get closer to the strike price of the long calls. But once I get towards the price of the long calls, as it goes up in value and beyond the strike price of the long calls, my risk gets lower and lower and lower. I kind of like lower and lower risk, don't you? All right, and let's finish with perhaps my second or first favorite trade of the night. Now, everybody wants you to believe options are horribly tricky to do and risky, and they are. They are because you got to get educated. Go to the Options Industry Council's website. They'll show you what you need to do. Go take a class. But notice we have specifically tried to construct an option spread that is unlimited upside and lower risk, and doing it at lower cost than buying a call. So you do not want this trade. I have taken this trade a lot in my younger years, and I've gotten smarter over time. It is the same curve as buying the stock, but instead of spending for 100 shares $2,600 or $20,640, you can control 100 shares for $735. Woo-hoo! I'll just go buy hundreds and hundreds and hundreds, because I could buy almost 400 shares for every 100 I was going to buy, or 40 contracts will cost me the same as 100 shares. So I might as well just go buy 40 contracts and turn myself into a millionaire. No, no. This trade has significant risk. Now, if you're a zillionaire, go for it. But if you're a common like the rest of us, you can't. The reason is it has the same equity curve as owning the stock. If you can't afford 4,000 shares of a $206 stock, don't buy 40 calls. We're talking about buying a few hundred shares here. So we've been modeling one call, but that which is 100, and you multiply that one by the number of hundreds of shares you want to control. So I don't think I would touch this trade. I told you earlier that I thought the market was getting towards a topping area. Why would I want to take unlimited downside risk? But I'll show you what you can do. Go in here and edit the spread. Why don't you buy a protective put? But it's not a married put because it's not going to be at the same strike price. So let's add an option leg. Let's, oops, we didn't want to do that. Did we want to buy a put? And we're going to buy a put at, say, 190. So in the money, or rather an out of the money put. Now look at what happens. Don't look there. I don't know what I did to change the settings. All right, let's talk about this. What does this look like? No, we don't want to do that either, do we? Kind of looks like a call, doesn't it? How much was the call going to cost me? $2,600. How much did I have to move to the right to be profitable on my 100 shares? $2,600. I had to move on each share to $26. Here I've got to move on each share $22. Why is this worse than a call? Because I may be getting in at $400 cheaper, but I'm risking $600 more because I have the put spread could go against me. Why do I like this trade? Because I have to move less to be profitable. It has unlimited upside, and it's got limited risk. How much room would I give a $200 stock? Well, I would give it no more than 8%, meaning my stop, which is about $16. Now, this is a little worse than risking $16 on a stock. But first I'd have to buy the stock to risk the 16. Here I can control 100 shares for $2,200, not 2,640, and it's got unlimited upside. So my favorite trades are a broken wing butterfly, cheap, hard to lose much because you know exactly what it's going to charge you, and you're protected if the stock moves a lot in your favor, but you're still capped on your upside. I like a married put. The problem is that put goes away when the strike at the when the month that the put is bought on, and you hope you're way in the monies or way out of the money, so the put expires worthless, and then you got to buy another one or think about what you're going to do on your trade. The back spread, not a bad stop. Buying a call, that works, but I'm probably going to do this trade on LEU because I have unlimited upside, less move to the right to be profitable, and I'm believing this thing's going higher, so I'm not too worried about that potential $10 to the downside on the put. Because remember, the price is $6.40 above the put, which means to max loss I'd have to be wrong $16. And nobody anywhere says you have to hold these spreads to expiration. So I got positive feedback last week of how I walk through, how I look at the option spreads and how I pick one. Look, I don't have unlimited time to do these. I want to do what you want to hear. Fortunately, my wife's on an airplane coming home, so she's not yelling at me to go watch TV because she's sort of retired and I'm not. But if you like these, please let me know. And anyway, subscribe, hit the remarks, and if you want to see how I perform this year, because the first time ever I'm trading a small account instead of a larger account because I was curious if what I did worked. It did. You'll have to join Top Down Trader and go pull the email that was sent out a couple days ago. If you want a trial or you want to purchase at the discount, reach out to me at marketmripro@gmail.com and have a happy Monday. And let's hope that if you're long, we don't get a big gap down. Right now, we're going to get a modest gap down, but most important thing is it hasn't continued to trade lower from the open. Thanks, everybody. Take care. Bye.